Welcome to this webinar on social sustainability and insurance of the AAE. A warm welcome to everybody and thank you for joining. Who is the AAE? The AAE is the actual association of Europe, and we are working, amongst other things, also in a working group which is called Sustainability and Climate-Related Risks on topics on sustainability. And what we want to share with you today is a discussion paper we just recently published, and we have all the authors with us who will present their parts. My name is Frank Schiller. I'm introducing and moderating the session. I'm working at Munich Re as Chief Pricing Actuary, and in the AE I'm board member, and actually I started the work of the working group of the Sustainability and Climate-Related Risks almost 4 years ago. The other authors, or the presenters for today, are the authors of the paper. The first presenter is Jérôme. Jérôme is a Swiss and French qualified actuary who works with Deloitte Switzerland in 2021 as director for sustainability services. He has over 20 years of experience in banking, insurance, consulting, and sustainable finance policy making. Jérôme currently chairs the Sustainability and Climate-Related Risk Working Group of the actual Association of Europe. Second is Esko. Esko is a Finnish qualified actuary. He has held numerous positions in the AE and the IAA, and currently chairs the Artificial Intelligence and Data Science Working Group of the AA. He was a member of the 2017 high-level expert group on sustainable finance, set up the European Commission as set up by the European Commission. Esko has retired from the position of Deputy Managing Director of Finance Finland and currently offers services under the name Actual Consulting and Insulting Esko Kivisaari. So I hope he won't insult us today that much. So let's cross fingers. Melissa is a UK and South African qualified actuary and currently serves on the Sustainability Practice Board of the UK Institute and Faculty of Actuaries. She has 18 years experience in the life and health insurance. She works for Swiss Re in Zurich as head of sustainability for life and health reinsurance business. And last but not least, Victoria. Victoria is an Austrian qualified actuary and is leading the ESG working group in the Austrian Association of Actuaries. She is currently working as a senior consultant at the Milliman office in Vienna and focuses on non-life insurance mathematics. She has 3 years of experience in consulting and 3 years of experience in product development and pricing. So as you see, we have a very diverse and very knowledgeable group of persons who have been working on the paper and who will present today just for the organization. If you have any questions you want to ask, please type them into the Q&A session. You will find that at the ribbon in the bottom where it states Q&A. There are speech bubbles there, and you can type it in, and we will use your input later at the end of the meeting, of the webinar, and the authors will answer your questions, or perhaps sometimes even also directly answer if they can answer in writing. So why have we been working on that topic? Why is it so important for us as the AE? And you might think we have done a lot already on climate change, but sustainability is obviously more than climate change. And when you look into the 3 dimensions of sustainability, it's environment. There has been a lot of work being done in that space. Then it's society, and it's economy. And the reason why we now have tackled society is that you cannot really drive the topic sustainability and then also climate change without also considering the other 2 dimensions, society and economy. And we thought, coming from the priorities, society is now really the next topic we have to discuss and manage as actuaries. And by that, we just really follow the quotation from the Brundtland Commission. Sustainability means meeting our own needs without compromising the ability of future generations to meet their own needs. And actually, it's not just about resources. It's about or natural resources. It's also about society and economy. And today, as I said, so for us, it's the second topic we wanted to address and discuss with you. Before we start with the presentation, I'd like to ask you a question. So perhaps if you could show the question or the poll before we start. And just afterwards, I would then hand over to Jérôme. So what do you think? Should insurance companies focus on the external impact on society? Is that something important for insurance companies as well? What's your opinion on that? So perhaps wait another, don't know, few seconds, and then we can show the results. So, well, perhaps the audience might be a bit biased because you are interested in the topic, and then obviously you think it should be really tackled, which is good to see. And well, that's also the reason why we have this presentation. I'd like to hand over to Jérôme, and he will give you like the starting point of the presentation.
Thank you, Frank, and good morning, everyone. Very happy to be with you today to talk about social sustainability in insurance. So before we go into the nitty-gritty details of the discussion, the what, the who, and the how around social sustainability with Victoria, Melissa, and Esko, I'll take a few minutes to try and set the scene, so to speak. What are we talking about, and why are we talking about it here with social sustainability in insurance? So the first question is the one we asked you, and probably, I guess, as Frank said, we have a biased audience that's already interested in the topics. But are social impacts a legitimate focus for private companies? Actually, some would say no, and that's been probably one of the dominant economic paradigm of the last decades. For instance, the influential economist Milton Friedman said that there's just one social responsibility of business: to use its resources to increase its profits. Also in the political sphere, you may remember the famous quote from Margaret Thatcher, former UK Prime Minister, who said in an interview that there is no such thing as society, meaning, and she went on explaining, they are primarily individuals who should first take care of themselves before thinking of any society-wide issue. So is this a new thing now with sustainability and ESG to look at the social impacts and social consequences of companies doing business? No, obviously not. We could go back centuries where this was more firmly front and center in the way, let's say in the way companies did business and thought about their role. For instance, car maker Henry Ford said that his ambition was to, quote, employ more men, spread the benefits to the greatest possible number, and help them build up their lives. Or even one of the founding fathers of modern capitalism, a Scottish economist, Adam Smith, who probably spent as much time writing about social issues as writing about the efficiency of markets, and who said, no society can be flourishing and happy where the far greater part of the members are poor and miserable. So now, within sustainability, is social something completely different from the rest, or can it be also looked at together with, say, climate topics within a common framework? We think it might be the case. So, for instance, let's take climate change, so comparing carbon emissions and social issues here. So carbon emissions can be categorized, as you may know, in three main buckets, according to the Greenhouse Gas Protocol. Scope 1 are the direct emissions from a given organization. Scope 2 are the emissions from the energy they buy and consume. And Scope 3 is all the rest, all the whole value chain, the supply chain, customers, companies they invest in, and users, etc. So in their excellent report from 2022, the Geneva Association, so for those of you who may not know them, they are a global think tank and insurance industry association. So in their 2022 report on social issues in insurance, they proposed that we could actually use the same kind of categorization and scopes for social impacts. Scope 1 would be the own employees of the insurer. Scope 2 are the local communities they operate in. And Scope 3, the whole value chain partners, customers, and investees. And what we are talking about in the report and today in the webinar, where what we focus on here is really this Scope 3 and in particular customers. So what we're going to talk about is the social impact of insurance products. The fact that there are similarities or that you could have a common lens or framework to look at climate and social doesn't mean, however, that they always go hand in hand. And in a way, it might be slightly misleading to use ESG, so environment, social, and governance, implying that it's a single thing and all the dimensions here can be worked on and improved simultaneously. No, to be honest, there are tensions here. So economic development, which is generally a positive social factor, unless it comes with grotesque levels of inequalities, has been historically based on, well, the massive use of cheap fossil fuel energy and the exploitation of nature, deforestation, land conversion, pollution, etc. So economic development is generally good for funding social services and for social development, but it's been correlated until now with high levels of environmental damage. So please have a look at the graph that's currently on screen. So what I try to plot here is, in a way, social versus climate. So horizontally, you have not GDP per person, which would be too crude a measure, but the United Nations Human Development Index, which is an aggregate index that puts together not just GDP per capita, but also things like literacy, life expectancy, access to health and public services, etc. So let's assume, for the sake of argument, it's a reasonably good proxy of social development in a given country. And then vertically, you have the CO2 emissions per capita. And what you see here is that there's a clear positive correlation between social development and carbon emissions. Yes, you have a few slightly outliers. Maybe some Nordic countries are doing a bit better. Some petrostates are doing worse. But there's a clear positive correlation, historically at least, between social development and carbon emissions. Interestingly, if you would put this graph with a logarithmic scale, it's almost a pure straight line. So supporting this idea of, at least until now, a correlation between social development and, let's say, pollution. And there are further differences within ESG between climate, nature, and social. I would pretend that climate change is a hard problem to solve, but a comparatively easy one to formulate. Why is that? We have one central metric, the tons of CO2 equivalent, and it's science-based. So maybe hard to measure, hard to solve, etc. But at least formulating the problem is, I would pretend, comparatively easy. Then when you move on to other nature topics like biodiversity loss, water pollution, deforestation, etc., it can still be science-based, but it's very difficult to summarize everything in one single variable, right? There are many possible metrics that you can and should look at. And then our topic today, social, is even more complex, because here you can not only are there many things to measure, but expectations may vary from one country to the next, from one social group to the next. It's cultural. There is no complete consensus on what good social indicators are, how to measure them, or for instance, which level of inequality is tolerable or even okay in a given country. To use a concrete example in the field of insurance, let's take health insurance. From one country to the next, it may be considered a basic human right or a luxury. You have sometimes culturally close and neighboring countries. Let's take Canada and the US, for instance, where in one country, health insurance is, you have universal coverage managed and funded by the state. And in the other, you have private insurance, which is and a coverage which is full of hole for segments of the population. And of course, you have everything in between. I'm speaking today from Zurich, Switzerland. In Switzerland, we have mandatory and standardized health insurance, but which is managed by private companies. So again, very different landscapes for a single given issue with crucial social consequences. So what we're hinting at here is that there's always a complex three-way relationship to consider between insurance customers, private insurance companies, and the state and public authorities, policymakers. An ideal situation is obviously one where there's no need for state intervention, but in practice, policymakers have to ensure that insurance markets are economically viable and that basic insurance is offered at reasonable prices to those who need it the most. It's the issues of availability, accessibility, and affordability of basic insurance products. So basic insurance products, we'll come back to that later on, but just as maybe a quick word about it, what might it be? It might be health insurance, might be household insurance for your primary residence, not necessarily for your third beach house if you have one. Even motor insurance is debatable in local context, because in some countries you do need a car to get around. In others, like, I don't know, Japan or Switzerland, public transportation is good enough that you can get pretty much everywhere. So again, local context. So this, all of those social questions in general and in insurance in particular are being increasingly discussed and recognized and integrated into international standards and into national regulation as well. International standards, it's quite interesting to observe the progression between climate to nature to social again. What you may have heard about the Task Force on Climate-Related Financial Disclosures, the TCFD, was launched way back in 2015, so almost 10 years ago, and it has been increasingly integrated in mandatory national regulation over the last few years. On other nature topics, the TNFD, Task Force on Nature-Related Financial Disclosures, is newer. It was launched in 2021 and is by and large still optional. And for social, it's on the horizon. So there's it's been announced that there will be a task force on inequality and social related financial disclosures, the ISFD, which is planned to launch later this year. Again, at the international level, the IFRS Foundation has a sustainability board who have included social issues in their IFRS S1 reporting standard for general requirements on sustainability related for sustainability related financial information. That was in 2023, so last year. We won't go into the details of many different countries in terms of national regulation, but it's important to mention the European Union here. So social topics are part of the Corporate Sustainability Reporting Directive, CSRD, which, I remind you, require double materiality considerations, meaning that large companies that report need not only analyze and report their own financial risks and opportunities, but also should take into consideration their external impacts. So in the CSRD, there are various modules called ESRS, European Sustainability Reporting Standards, and 4 of them are dedicated to social topics. S1 on workforce, S2 workers in the value chain, S3 affected communities, and S4 consumers and end users. So large companies and also large insurance companies in the EU have to report on these if they are deemed material. And from what I've personally heard or seen so far, many insurance companies consider S1 on workforce and S4 consumers and end users to be material. And if we want to put what we are talking about today into a CSRD language, what we're focusing on, again, is insurance products, which would be here in this classification, ESRS S4. But enough with general considerations. Now let's go into more details and more specific examples, and I'll give the floor to next to Victoria.
Thank you, Jérôme, and good morning also from my side. So now we will be discussing the what, meaning how the insurance industry is impacting the society and especially their customers on multiple levels. And as Jérôme already said, the evaluation is rather complex. But there are various frameworks that can be used to understand the social impact. And after exploring 2 helpful frameworks, we will also look at 2 illustrative use cases. And the first framework that can help us to understand the social impact is the Maslow's hierarchy of needs. You can see on the left-hand side of the slide, and this pyramid illustrates human needs and motivation with basic physiological needs at the bottom and higher psychological needs at the top. And the general idea is that insurance is providing security and safety around the basic needs to increase the ability of customers to pursue the higher level needs. And we will see some examples in a few minutes. And this framework and also other hierarchy frameworks can be useful tools for insurers and actuaries to analyze the utility of different insurance products. And the second framework that can help us analyze or evaluate the social role of insurance is mapping the social mission onto the United Nations Sustainability Development Goals. And the global goals were adopted by the United Nations in 2015. And the goal is to protect the planet and to achieve prosperity and peace for all people by 2030. And I think the goals are probably quite known to most of you already. So there are 17 SDGs, and the social ambitions range from hunger and poverty ending to empowering women by improving health and education, to reducing inequalities and supporting economic growth. And mapping the social mission onto the SDGs highlights how insurance plays a role in achieving the sustainable development. And I personally really like this visualization that you can see on the right-hand side. It's called SDG Wedding Cake of the Stockholm Resilience Center, because it's also great to highlight the interdependencies of the goals. And coming now to the question, what social role does insurance play? So there are several social needs and goals that are addressed by insurers. And if we look at the frameworks, there are at least 7 SDGs where insurance is contributing to and is meeting almost all the steps of Maslow's hierarchy of needs. But in this presentation, I just want to highlight some of them. But of course, you can find more details in our paper. So if we go to the next slide. exactly. The first thing that I want to mention is good relationships. Because if we look, for example, at liability insurance, it's offering financial compensation for affected parties and tries to avoid or reduce conflicts or legal disputes, and is thereby helping to maintain good relationships and also a sense of social fairness. And in general, by removing financial burdens such as medical bills or reparation costs or reconstruction costs, individuals can focus on their recovery and continue with healthy relationships and participations in normal social activities. And insurance can also help to achieve gender equality, which also supports good relationships in a sense by offering specific insurance solutions for women, such as maternal health care, for example, or daycare for children. And the next point that I want to mention is boosting sustainable developments and initiatives. Because if we look beyond underwriting, the insurers as a collective are one of the biggest asset owners and investors and are thereby capable of boosting the sustainable development agenda via the asset management policies. And also with the expertise on climate change impacts, they can help to drive sustainable development as well. And another social role insurance is contributing to is physical well-being, because of course securing health and well-being is a focus of health insurers and also most life insurers. And the insurance can then promote preventative healthcare, and also early detection of diseases or the rapid access for healthcare. And if we look at the frameworks that can also be mapped, for example, to SDG 3, good health and well-being. And last but not least, there's also the social role of insurance as a financial safety net. Because insurance can be seen as some kind of safety net, because it's protecting the individual's basic needs and preventing them from falling into poverty by providing the financial compensation in case of unexpected events. And thereby, the individuals can focus more on pursuing the higher level needs, as mentioned in the beginning. And especially looking at climate change, for example, the insurance against natural catastrophes can act as a big safety net as well. Although we should mention that according to statistics of 2022, almost 76% of the world's natural catastrophe risk is still uninsured. So we can see there's still a significant gap in the insurance coverage. And there are also other insurance products that can act as a financial safety net or providing financial security, as for example, life insurance products for bereaved family members, such as funeral costs, for example, or financial security for business owners, which is then promoting entrepreneurship and investments and is stimulating economic growth. And looking at the SDGs again, we can also see that it can be mapped again to several SDGs, as SDG 1 and 2, no hunger and no poverty, other way around, and SDG 8, economic growth. So yeah, but it should be noted that, of course, not all insurance serves some kind of basic needs or even mid-level needs. Consider, for example, luxury goods or the private assets of the world's wealthy. They are also underwritten by insurers, of course. But we can see there is a big contribution from the insurance to social sustainability and social impact on the society and on their customers. And to highlight this even more, I now want to explain 2 use cases to you. And the first one that I want to mention is microinsurance in Africa. And microinsurance can act as a safety net for vulnerable communities who were typically excluded from the mainstream insurance markets. And yeah, how does it work? So the individuals with microinsurance, they pay a small amount on a regular basis to the insurance company, and the insurance pays in case the individuals are experiencing some kind of a shock, as for example, losing harvest or medical bills due to an illness or an injury. And the microinsurance market in Africa has seen significant growth in the last couple of years, at least in some African countries. You can also see it on the map, even if this one is from 2014. Well, it's the same direction. But what I want to mention here as well is that there are new challenges that came up, especially also during the COVID pandemic, such as economic disruptions and the immense demand for healthcare. And there's also the Global Shield initiatives that was launched in November 22 at the COP27. It's also aiming to increase the amount of people with direct or indirect insurance coverage for climate risks, against climate risks. And while microinsurance in Africa is, or microinsurance in general is primarily relevant for emerging economies, mental health insurance is also, or mental health is also a big challenge in Europe and in the developed world. And the prevention and treatment of mental health gained in importance in the last couple of years and has become a key topic for many insurers. And especially, as you can also see on the graphs, the COVID-19 pandemic highlighted the importance of mental health, leading to an increase in mental health support and specific insurance solutions. And on the graph, you can see the increase of mental disorders during the pandemic. So now insurance companies are offering more treatment possibilities like mental health coaching, or embracing new tools like telemedicine or self-help guides, or other forms of therapies and community interventions for the mental well-being. And yeah, I hope I could highlight the social role of insurance, and will now hand to Melissa to talk about the WHO.
Thanks very much, Victoria. So firstly, just hello to everybody, and very pleased to be able to join my co-authors and present this work to you today. I'm going to be answering the question of who does insurance serve, or perhaps a more provocative way to phrase the question, who does insurance currently not serve? Perhaps that framing fuels some more interesting consideration of the question. I'm going to ask you for a little bit of forgiveness. The examples that I share will largely come from the life and health insurance sector as opposed to the non-life sector, and that's purely a result of my own personal experience. But I'm sure those of you who are on the call representing the non-life world can think of some parallel examples with similar characteristics as well. I'd like to begin by referencing an ERPA consultation that came out very recently in December last year, which is about the prudential treatment of sustainability risks. It's a very broad, long consultation, but there are certainly parts of that consultation that do reference this question of who do we serve or who do we not serve. It uses language that teases the question very strongly, words such as diverse range of clients, vulnerable parts of society, and the whole area of financial inclusion, and does tend to encourage insurers to consider this in their assessment of social sustainability risks and opportunities. This part of our research and the accompanying paper for this webinar goes into 4 different discussion points, and so I'm going to cover each of those in turn. If we go to the next slide, I'll address the first one of those discussion points, which is around the question of whether products are offered to consumers in a way that is compulsory versus relying on the propensity of consumers to buy the products that insurers provide, or what we call a compulsion spectrum. I'm going to draw your attention rather to the bottom of the slide first, and start by discussing products that are compulsory in nature, and some of them have been mentioned earlier on this call already. What we mean by compulsory is that the law requires the purchase of insurance. A good example is motor third-party cover, for example, but there are others. The case there referenced in the UAE with unemployment insurance is a relatively new law that's been introduced there about a year ago, and so that example is referenced in the paper as well. At the middle part of the spectrum, we have soft compulsion. So what we mean by soft compulsion is that the law doesn't necessarily require it to be bought. However, market practice or some other systemic factors mean that effectively that type of insurance is compulsory for customers. So in the context of accessing credit, for example, often that requires the borrower to also have life or income insurance in place to fund that credit, and it may require the borrower to also make sure that insurance is placed, is purchased to cover the asset that is funded from that credit. So if that's mortgage insurance, then a home, for example, business insurance, perhaps the physical assets of the business, and so on. At the top end of the spectrum, we have products that rather rely on the propensity to buy, or because insurance still remains a product that is rather sold and not bought. You could rephrase that as the propensity to be sold to. And the reality of our world is that as social inequality persists, it is a natural consequence that those customers or potential customers who have more resources to buy these sorts of products are going to be the first or the easier targets and more attractive customers for providers of insurance and sellers of insurance or distributors of insurance to approach here. It does create the question or the risk that potentially at this end of the spectrum, the nature that we're relying on propensity to buy means that inequalities can even be entrenched rather than reduced by the products that we provide. And I think this is potentially an interesting area for further or deeper research and understanding of the role that our sector, the insurance sector, plays here. Now, this compulsion versus propensity to buy spectrum maps quite nicely to Maslow's hierarchy of needs, which Victoria introduced earlier. So those products that are rather more compulsory do map quite closely to those lower levels of the pyramid, so where they relate more to physiological needs, whereas products at the upper end of the spectrum rather relate more to psychological needs. For example, protecting one's legacy or maintaining one's legacy, passing on wealth to the next generation, etc. And it is quite logical or rational that those products at the relevant to the lower part of Maslow's hierarchy remain compulsory or have some degree of compulsion, whereas those at the top are rather optional. We can move to the next slide, and I'll introduce the next discussion area under the who question, which is the area of vulnerability. Now, I think it's a truth that the same loss event doesn't necessarily impact two customers in exactly the same way, where one of those customers may have higher social deprivations to begin with, and all other things are equal. And it's an unfortunate reality that if we think of climate risk, for example, already climate impacts are seen to be, and in future perhaps even more so, climate impacts are greater in parts of the world where social deprivation is already high and insurance penetration is low. So there's quite a strong correlation there if you look at the global data or the global map. I think the Human Development Index of the United Nations, and Jérôme used this index in the chart he showed earlier about per capita emissions versus HDI, is a useful reality check here. To go into a little bit more of an explanation of what the HDI is, it is a simple unweighted average of measures of longevity, education, and income levels. So it's a very nice indicator of social progress. Now, if you look at the last 2 years of available data, so that's 2020 and 2021 for the HDI, you will see that sadly, for the first time in its roughly 30-year history, the HDI has in fact declined. So that's the global average has reduced in 2 successive years. Not surprisingly, a huge part of that reduction is attributable to the COVID pandemic, of course. If you segment the data at a more granular level, and you look at different groupings of countries, those with low HDI levels, high, very high, as is shown on the graph here in the slide, you can see that it is more the low and medium and high HDI countries that have a greater proportion of those have seen reductions. So that's suggestive that inequality is even increasing when it comes to social development. Just a little side comment here that this data is a little bit old, 2021, but actually next week on the 13th of March, we're expecting another update from the UN on this. So if you're interested in this topic, then I'd encourage you to go and look at their website on the 13th of March to see how this index has developed since 2021. Now, the United Nations recommends, based on the performance of the HDI, they recommend 3 different policy interventions. Conveniently, they all start with the letter I. And those 3 interventions relate to investment, innovation, and insurance to address future improvements in human development. What insurance means in that context is a move away from risk segmentation and towards broader risk sharing. And clearly, our industry has a key role to play here. We can go to the next slide. The third area under the WHO question is a case for inclusion that looks at cultural and legal matters. I think it's important to begin this part by quickly giving you a distinction between what we mean by differentiation versus discrimination. Discrimination is the treatment of people in a way that is unlawful and/or unacceptable, whereas differentiation is the opposite of that. Treatment of people obviously needs to be in compliance with the law, and it needs to be also culturally acceptable. In addition, it should also be justifiable. In other words, there should be data to show that there's good grounds for that differentiation. Now, both laws and culture are not static. They do change over time. And in fact, even at the same point in time, they are not static across geographies or cultures. They do vary a lot. Jérôme already referenced the example of different cultural attitudes towards socially funded healthcare, for example, in a European context that is largely accepted or expected in a way. In a US context, it is still a very controversial point and clearly not available or in place yet. Now, there are various social tipping points that we can identify that often trigger either a change in laws or change in cultural acceptability or both. To reference a quick past example, I'm sure many of you might remember the impacts of the EU Gender Directive, which actually came into place now more than 10 years ago, so more than a decade ago. At the time, there was great nervousness in the industry that it was going to cause quite significant disruption in the stability of the performance of insurance. But actually today, nobody really talks about the gender directive anymore, and it is now an unchallenged practice. It's accepted, and there's very little discussion about it anymore. So that has been a tipping point that has become accepted. Looking more at the present day and some examples that are developing at the moment. In the life and health sector, a very hot topic in Europe is the development around the right to forget cancer movement. For those of you who might not be aware of this, effectively what has happened is consumer groups have successfully been campaigning for the right of cancer survivors to access certain kinds of life insurance for reasons of fairness or non-discrimination. This usually relates, quite interestingly, with products that are in the soft compulsion segment of the spectrum I shared earlier, so associated with the middle to lower levels of Maslow's hierarchy of needs. I think this is admirable to make sure that people who most need the products that we offer are able to access them, and so a positive for social sustainability, but it is not so straightforward, and it does create some other challenging questions. So to give you an idea of what those questions might be, one of them could be, well, by making these products available to cancer survivors, that has to be subsidized from somewhere else. So does it mean that protection then becomes less affordable for everybody else, including those who potentially are not purchasing the product for affordability reasons today already? The second question is, if this is being applied to life benefits, as it is in most jurisdictions across Europe at the moment, then is there a risk that it could potentially spill over into other benefits such as critical illness? And if that happens, very likely no insurer would want to offer critical illness cover to any customer, including those who are not cancer survivors at the moment, making that product unavailable to all customers, which would be obviously a negative outcome overall. A third question you might ask is, why the special treatment just for cancer survivors? If the motivation here is non-discrimination, then what about people who are suffering from other disabilities or other diseases? They should potentially be considered as well, because their rights are also just as important, even if their voice might not be as loud as the cancer survivor consumer groups. I'm not going to offer answers to these questions, but raising them is simply to give you an appreciation for how complex some of the decision-making around these areas is. We can refer to other examples from the US. I won't go into as much detail on either of these cases, but another social tipping point in the US context has been the rise of DEI, or diversity, equity, and inclusion, if you're not familiar with the acronym. Really, this goes back and was triggered by the murder of George Floyd some years ago, and the rise of the Black Lives Matter movement in the US. All corporates, including insurers, are looking at the way that they treat their own employees, and insurers are also starting to look at the way they treat their own customers, or don't serve their own customers, don't have sufficient Black customers represented in their portfolios. The third example is a non-life case. And in the US, I'm sure many of you would be seeing some of the headlines coming out of states such as California and Florida, and most recently I've seen out of Idaho as well, where many property insurers are choosing to exit those markets as a result of growing climate risks and untenable market conditions where regulators are constraining their ability to increase pricing in accordance with the deterioration in experience. Insurers are facing heavy criticism from social perspectives for doing this. And it's a really good example of seeing how environmental and social issues are often or can be in strong conflict with each other. And then if we go to my fourth and last area of discussion, there is also a very strong commercial case for inclusion, or this question around who do we serve or who do we not serve. Protection gaps clearly represent an untapped potential, and that is value that can still be created now and in the future for shareholders. It is clearly difficult, which is why protection gaps have persisted for so long and is an unsolved problem in a way. And the right business models need to be sought, the right partners need to be sought in order to address them. But perhaps in these segments, given the lack of attention to them, there's even an argument to say that price-driven competition might be less here than in the segments that our industry is already very familiar with. In the context of life insurance, underwriting around certain health conditions and towards groups of customers who suffer from chronic illness has really improved and modernized in recent times. Mental health conditions, such as the cases Victoria shared, is a good example. People suffering from HIV, as the treatments and antiretroviral drugs have become much more effective in managing those conditions. Those are two good examples to look at. There are a lot of misconceptions I found around some of these risk categories that we immediately assume that they are higher risk and therefore unattractive. But actually, if you dig deeper into understanding some of these underserved customer groups, you can see some very promising insights. For example, in this case of people suffering from chronic health conditions or managing chronic health conditions in their personal lives, what some of the research shows is that often these customers are much better informed and equipped around their own health in terms of managing their health more generally, not just in relation to their specific condition, but being more proactive overall with respect to their health, given the health shocks that they have experienced and the diagnosis that they are managing on a day-to-day basis. The last point I would like to raise is just to reference a bit of work that I helped to produce within Swiss Re. Sorry, Jérôme, thank you. Within Swiss Re, which is a piece of research that was published last year. It is called the Life and Health Insurance Inclusion Radar, and it is a study across 16 life and health insurance markets globally on the degree to which those markets are inclusive. And the headline conclusion of that work is that none of the 16 markets studied are fully inclusive, and there is room for improvement everywhere. I'm sharing here the 4 recommendations from that work that came out of the research reports, which you're welcome to go and read further. The first 3 are perhaps more obvious, that we really need to do more research into underserved groups. We need different partnerships and we need simpler products. The 4th one is perhaps a little bit more subtle or unexpected, but a barrier that we find really comes in the form of regulation. So regulation that is focused on consumers is often very much driven towards the goal of consumer protection. But often what we find is that sometimes that consumer protection regulation is at odds or in conflict with improving access or making it easier to reach customers, particularly lower income customer groups. And so a recommendation there is around more dialogue on this point and understanding how these 2 goals can potentially interact, that both are important and that there needs to be some balance in making sure that both consumers are protected, but we are also able to access them with the products and services that we provide, particularly recognizing that underserved groups are usually the more vulnerable ones. I will stop there and hand over to Esko for the last of our 3 questions.
Okay, good morning, everybody, and happy International Women's Day for at least half of the audience, or about half of the audience. This is certainly a good day to talk about the topic we are talking about today. I would say that insurers have a lot of critical thinking to do with respect to how they have treated this certain group of individuals, both as employees and insurers or customers. I will not say much about what it is to employees, since I think their insurers are in the same position as any employer. But my issue is about underwriting and how to treat customers. And the question really is that does differentiation always lead to discrimination, as Melissa was looking at these topics. So next, please, or click, please. Well, when doing the premiums, we have the actuarial premium. Of course, we have the commercial premium after that, but the actuarial premium differentiates between risks and reflects our understanding of the risk. The premium as such should reflect the riskiness and categorize risks into different categories. So click please. And there, well, it is quite easy to avoid direct discrimination, looking at the protected attributes and making sure those are not harmed. But then we have a much more difficult question of indirect discrimination and how to avoid the thing that what we actually do really categorizes individuals in a way that is not acceptable. When looking at the factors used, we have some criteria to avoid going into undue discrimination. When we have our underwriting criteria, when we have our factors, we should look at whether they are necessary, appropriate, and legitimate. Necessary in the sense that they are really reflecting the risks we are looking at, appropriate, so that they can really be used in a fair way, and legitimate in the sense that they are not hurting the protected attributes. Next one, please. And click one again. Well, traditionally we have been in the situation where our data is scarce. It is also expensive. Data storage has been slow and inadequate, and computing power has been expensive even when it's available. Next one, I'll click. So we have used simple proxies like gender to evaluate risks we were using. Well, gender has been forbidden already, but I guess with more and more data, we can say that gender is probably not so important, and maybe that's one reason for Melissa to say that there has not been much discussion on this, because as I have been saying is that if we know a person's shopping history for 10 years, if he know how often he or she goes to the gym, if he know what he or she buys from the pharmacy, we couldn't be less interested on the gender when we do the underwriting, because we know much more of the risks of this person. Next, please. And now we are in this different situation where we could have all kinds of data I mentioned a minute ago. We have cheap computing power in the cloud. We have huge amounts of storage in the cloud or otherwise, and we have huge amounts of data gathered by this digitalized society. And then the question is, how much can we use that, and how can we use that in a fair way? Next one, please. Risk modeling has become more accurate than ever before. We as dataholics certainly like to have all the data and play with it. But then we have the question of how to honor the privacy, how to get better transparency of the complex algorithms that are used. We are just waiting for, in the European Union, the AI Act to be published that will say quite a lot of things in this area, and obeying or complying with the AI Act will be one of the big challenges for insurers and for our profession. Next one, please. Well, one of the things to note here is that discrimination, well, you can say that modern technology creates discrimination, but actually we have always had biases and discrimination in our traditional methods. So in some senses, our new technologies are making world a better place, in the sense that AI data processing can make clear when we have discrimination and biased decision making, and technology as such can help us in being clearer and finding out when there is discrimination. Next one, please. And click one again. But while new technology can help in finding out where there is discrimination in the old world, it can also introduce new sources of concern. The models are really complex. Sometimes they are black boxes. In many cases, we have continuous machine learning, which means that the model adjusts all the time. And it is really challenging to make certain there is no undue discrimination in indirect form. Next one, please. What we should do with our models, with our modern technology to help us forward to extend insurance, to extend risk sharing into areas where it hasn't been possible, and making lives better. We should especially look at into our models in a couple of areas. Models can introduce excess poverty premiums or ethnicity premiums, or then loyalty premiums can also be a problem. At least these poverty premia and ethnicity premia seem to be very much a discussion point in the UK, where there was even an article recently in BBC on how travel insurance treats people in an unfair way, raising the premia of some neighborhoods in relation to others, with no real connection to anything like the vulnerabilities or the risks of that region. I think I'm done with this. We have the issue of discrimination. We have the issue of differentiation. We have techniques to work in that area. We need to be certain that we are using these technologies to help the world and not make life more difficult. And especially we need to look at the so-called essential covers, where essential means insurance products that are essential to social inclusion, meaning that certainly you should have health insurance, you should have traffic insurance to be included in the society. Especially in those areas, we need to find good ways of making insurance available at a fair price to the maximum number of people. Thank you.
Thank you, Esko. So I'll briefly come back to try and wrap it up before we go into the Q&A session. So we tried with this webinar, with this paper, with the research we've done, to really look and analyze many different levers that insurers have to adjust and improve their impact, their social impacts. So what we can do is maybe summarize them into 4 main recommendations. First one would be to engage openly with regulators and policymakers on social topics. Second one, and very relevant for actuaries in particular, is to try and quantify their social impacts and design new customer impact measures and metrics within underwriting. Maybe a third recommendation would be to integrate even more social considerations within project development strategies. And again, I guess all four of us said it at different times, with a special focus on what could be considered basic insurance, without which individuals are marginalized in society. And four, to also engage with all other relevant partners and stakeholders in the insurance value chain. So that may be, of course, customers and customer associations as well. That may be relevant NGOs, and of course, those who sell the products and manage the client relationship, which in many cases can be insurance intermediaries, such as brokers, agents, and the like, who may not always be up to speed or as concerned by social considerations traditionally. So those were general recommendations related to insurance, maybe not specifically for actuaries. What can actuaries and insurance risk managers specifically do? So we believe that we can and we should meaningfully contribute to these discussions on social issues. And in particular, we have a natural role to play in helping to quantify social impacts, risks, and opportunities for insurers and for society as a whole. With a word of caution, though, there will be many cases where a fair, meaning actually correct risk-based insurance premium might also be simultaneously, in another sense, unfair, meaning coming with leading to negative social outcomes, leading to basic insurance becoming unavailable or unaffordable for vulnerable populations because of their socio-economic status, because they've been sick in the past, for instance. So there are many such trade-offs that have to be identified and managed. And we think that actuaries are well placed to do that if they do not just the risk assessments, but also contribute to the risk management and risk sharing discussion. So in conclusion, you may or may not agree with everything we've mentioned, the arguments we've made, but what we hope, and that's the purpose of this paper, this discussion paper and this webinar, that we've been able to stimulate further discussion on those social topics, and that we will, you will all walk away from either reading the paper or this webinar today with being convinced that we should all in the insurance sector engage more proactively and more actively on social issues for insurance and for insurance customers. Thanks a lot. So I'll hand back to Frank now for some Q&As.
Yes, thank you all four of you for this inspiring presentation. So it was really great to see and have this very well done presentation on the results of your paper, and I hope that even if you haven't read it yet, to the audience, that you start reading now this paper, because there you get much more details and you also get all the references to the topics that have been mentioned in the paper or in the presentation today. I want to start first actually with the slide you presented, Jérôme, at the very end, the conclusion and the recommendations to insurers. So when I ask you one by one, what of these four recommendations will you pick? What's your preference? Where do you think we as in actuaries working insurance might have the biggest lever? Just to remember. So the first topic was engage openly with regulators. The second topic was design new customer impact measures. The third one was integrate social considerations within underwriting and product strategies. And the fourth one was engage proactively with all relevant partners in the value chain. So perhaps if I may ask you first, Jérôme, what's the topic you want to tackle first, because you think that's the one with the most impact we could have as actuaries in insurance?
Okay, so if you ask with a specific actuarial angle, I will probably take number 2, meaning trying to quantify such social risks, impacts, and opportunities. Because even though, as we all mentioned during our talk, it's very difficult to come down with a single metric that would summarize all social issues. Maybe it works at the aggregate level of a country with HDI, for instance, the Human Development Index that we talked about. But at the level of a single customer or even a customer group, that's much more difficult. But still, we live in a world where what's not measured then gets less attention. So trying to design KPIs, key performance or key performance or risk or impact indicators around the effect of social products, of insurance products on social issues is something that I would pick first.
Mm-hmm. Thank you, Jérôme. Esko, just in the reverse order, what would you think? What's the most topic, the most relevant topic for us having an impact as actuaries? Or perhaps Melissa, you want to jump in? Esko is still thinking of about the question.
Sure, happy to jump in. We come back to Esko. A little bit boring. I actually agree with Jérôme, but I assure you that was my decision before hearing his answer. Maybe I give you just a different justification why I think the measurement recommendation is a more important one. I agree with the justifications Jérôme has shared already, but another factor relates to the point that was raised earlier. If you look at environment, and particularly climate, there's a very easy measure. It's CO2 emissions. The challenge on environment is how do we get action given all the trade-offs around trying to reduce emissions. The challenge, at least the first challenge on social sustainability, I think, is this measurement piece. It's a lot more difficult to measure than CO2 emissions. And so we have to do some experimentation, data analysis, new data collection, before we can settle, hopefully, on something that we can use consistently across different organizations and across the world.
Thank you, Melissa. I'm looking now to Esko if he's ready to answer, but perhaps not yet. Oh, yes.
Well, to tell the truth, I was writing an answer to Gabor, who asked us. So could you repeat the question first?
Yeah, so
it's usually better to know the question before answering, but
yes,
not always.
So looking at those 4 recommendations on Jérôme's slide in his conclusion, he proposed 4 areas where we could focus on as insurers: engage with the regulators, design new measures, integrate social considerations in underwriting and products, or strategies there, and also 4th one, engage proactively with partners in the value chain. Where do you think, where could we as actuaries have the biggest lever? Where could we have the biggest impact in driving forward sustainability topics, social sustainability topics for insurers?
Well, I'm generally concerned over the fact that, well, actuaries and insurers think they know everything, that they have the best knowledge of everything, and they are not so ready to look and integrate with the outside world, which, well, we have had this in many areas, like in my experience, like say in accounting and the discussions with the International Accounting Standards Board and different players, and we think we know better. We should have our eyes open, more open than they have been, to really discuss with different NGOs, stakeholders, listen to their concerns, and rather be a constructive expert profession to really look at the problems and to see how we can use our expertise to solve those problems. If we just think that we take care of our own business, then probably we are answering or solving problems that do not exist.
So it's kind of a mixture between number 1 and number 4, but then also
number 1 and number 4, right? Yeah.
Excellent. Well, thank you, Esko, for these thoughts. Victoria, last but not least, what are your thoughts?
Yeah, so from like an actuary perspective, I would totally agree with Melissa and Jérôme. But from like a more broader perspective, I also really agree with Esko, because I think communication and collaboration is a key in such a complex topic to promote the sustainable practices, and also transparency is a key to also build and foster the trust and confidence around this topic. So yeah, in this case, I would also say it's like a mix of 1 and 4.
Mm-hmm. Excellent, thank you so much. Actually, we're quite busy already writing your questions in the Q&A feature of Zoom. Some of them have already been answered. So perhaps if all the others who weren't yet asking questions, you could also look there. And I would very briefly go through the already answered questions, but perhaps we start first with the not yet answered questions. So Monica asks, there was just published that AI perpetuates biases. How can insurers take care to fight these phenomenon? Which is actually part of the topic you addressed, Esko, in the area of discrimination versus differentiation. So who wants to take it? Melissa, you also had it on your topics. I don't know, either one of you who wants to answer?
Well, I must be repeating myself in saying that firstly, certainly AI can reveal biases that are human practice. But then again, we need to be careful in how we use AI. What we were proposing in the paper, in the AAE paper, was heavy emphasis on a thing called XAI, which is the explainable artificial intelligence, where I think we will have huge challenges in the future, since the models, well, I think traditionally our standards say that we should understand everything that happens with our models. But certainly when we go to machine learning models, it's difficult to understand the model, and then after that the model adapts to new data all the time. So how can you know what is really going on there? So I would only say to Monica that well, good question and huge challenges ahead.
Thank you.
Frank, if I can add a little bit to Esko's comments. Just to say, first of all, I think AI gets so quickly and so easily knocked down because, yes, absolutely. I think as actuaries, we can all understand how it can quite easily perpetuate biases. But it's important to note that AI is not the only source of bias in our business and our products, and we have to address all bias, not only AI bias. And the other comment I would make is that I think it points us to the G of ESG, making sure that the governance we have around the tools that we use, the technologies that we use, as those become more and more sophisticated, they are applied in a way that is ethical and responsible towards social issues and, of course, other issues as well.
Mm-hmm. Thank you. I think that was, or hopefully that was what you expected, Monica. Then there was actually several questions, actually even perhaps already a conversation between Gabor and Esko on the question, okay, how can we do that? I started off actually with the quote from the Brundtland Commission that actually we have to meet our own needs without compromising the ability of future generations to meet their needs. And then the big question is, okay, when it comes to social aspects, that was already discussed, and actually also the focus area, what you just mentioned in the conclusion, it is hard to measure, and it's hard to understand what are the needs even now, but how can we be sure that we understand already now the needs of the future generations? So how could we do that? And perhaps Esko, if you want to also very briefly reply also verbally, that we have it also in our recording, what you answered to Gabor's thoughts, and then also to the further questions.
Well, I would say Gabor's questions led to very lengthy philosophy. Basically, the issue there is that what are the good things? Am I personally a measure for what everybody does? If I need something, if I think something, can I then infer from that what is good for everybody? And certainly not. So that leads to the first better formulation came from Immanuel Kant, and then in the last century John Rawls was looking at that, and there is extensive literature on how to proceed from individual thinking to more extensive way of looking at things. But certainly, of course, we have also the difficulty that which is facing much more today, is that are these values we are looking in ESG, are they only the values of the so-called liberal Western democracies? And how about the so-called global South that is not really global and not really South, but anyway consists of a huge number of people that are claimed to have totally different value systems. Thanks.
Mm-hmm. Thank you, Esko. Jérôme, you also wanted to add something on this topic.
Yes, briefly on this, indeed, very philosophical and political discussion about what's fair and what's not fair from a social perspective as well. I assume that most of us would agree on this very simplified statement that if I choose to take a risk, that's my responsibility, and it's okay if my insurance is very expensive, or even if I'm denied cover. And oppositely, for things that I cannot influence, like whether I'm a man or woman at birth, I don't choose my chromosomes, then I shouldn't be penalized. But even this is too simplified, because everything exists on a continuum. It's not binary. For instance, having expensive car insurance because you live in a poor neighborhood with more accidents and car theft, etc., it's probably bang in the middle. Yes, on some level, you choose where to live, but on another, it's constrained by your financial means, by your upbringing, by the type of family and social groups you grew up in, etc. So I think everything exists on a continuum, and it's been interesting, as noted before, to see progress on mental health. Until very recently, most of the insurance industry had a very antiquated, I think, view of mental health, like, oh, you visited once a psychiatrist in your life, then you're crazy, I don't want to insure you. I think in a way, COVID has had this, among many issues, has revealed that mental health is really a continuum, and insurability and affordability and access is improving.
Thank you. Perhaps also going down that route, there's another question from, I hope I pronounced the name correctly, Siwon Tan. And the question asks, so when poor people are struggling to survive, how to get them to purchase microinsurance and understand insurance. So it's also about education and understanding the needs. Would that be more efficient if government improved public medical services, for instance, or other services, also for non-life. There are many good things that both government and insurance companies can do for the society. So I'm asking this to understand which approach has higher impact overall. And I think that's also one of the big questions. So who is the best owner? In that direction, also a question came from Gabor. How could we even cooperate, governments and insurance companies, in kind of public-private partnerships? So how can we really tackle this problem of affordability, availability, for topics that are really relevant for like securing society and financing all these needs, also during climate change, during the transition in climate change. So Victoria already answered. Who wants to take it? Do you want to start first, Victoria, and someone else wants to add?
Yeah, maybe just a few additional comments. So I wasn't sure if there's like the one answer to give, like there's one solution for it. But I think the first thing to do is to analyze what the challenges are in the different markets or in the different countries, because I think there are different challenges in different areas. And that's the first thing to do. So what do we need to do to meet their needs, or what are the needs? So I think that's the first thing. And then I think we're really dependent on collaborations with different organizations, or so with governments as well, but also with insurtechs or NGOs, for example. And yeah, sometimes insurance products are also embedded in other services, so there can be a collaboration as well. So I think there's not one company or one organization that's responsible for the whole progress.
Mm-hmm.
I could continue if okay, but we are certainly
Yes,
running
please.
out of time. but I mean, I guess insurance and risk sharing is only possible generally with good public-private partnership. We always need the public sector to do certain things. Just look at, for example, traffic safety. We cannot, we can set up risk sharing there, but really to avoid deaths, traffic deaths, to have traffic safety, insurers or actuaries cannot do that by themselves. We need the public sector to improve the infrastructure. We need the car manufacturers to look at the safety, and then insurance and risk sharing can complement the issue. Just mentioning one area there was a discussion of gender here, but I would say that the bigger question, at least where I come from, is the differences in longevity between socio-economic groups, since when we look at the lowest decile and the highest decile, the difference in longevity is larger than between men and women, and that is really one of the difficult problems we need to look at.
Yeah, definitely. Being conscious of time, so we are already at 11:30. So the official time for the webinar is actually just over. Thank you all for your contributions. Thank you, the 4 presenters, for having this great presentation and also the paper prepared for the discussion today. We all saw that it is first very relevant. It was very inspiring for us all, and we had a great discussion afterwards. And I think we could continue for the next 30 or perhaps even 30 minutes or even an hour in this conversation. So we need to discuss this topic, and that's the reason why we called it a discussion paper, because that's something we have to really carry on and really understand better and evolve better. So thanks again for all of you. Please leave us some comments or also give us a feedback if you liked it. What did you like of the webinar? If you didn't like it, what didn't you like it? What didn't you like at the webinar? So it's also important for us to improve our our program. Thank you again for joining, and looking forward to seeing you next time at the same or similar webinar of the AAE. And stay safe and have a great weekend.